Hi everyone, and welcome to the 5 Reasons Why Ethical Investing Could Boost Your Returns. I'm Tom Wilson. I'm the investor educator at InvestSmart and also help at the Intelligent Investor for these raises. And this is about the secondary offer for the Intelligent Investor Ethical Share Fund. Has the ticker code of INES. We do have Nathan Bell waiting in the green room, so to speak, so he's coming on. But first, what I'll quickly do is I'll just run through some of the housekeeping for us. And as always, we provide the general product advice only, not personal financial advice. And moving on to the next screen here. So we have secondary offers, and it's an opportunity where we say to our previous investors or even new investors that they actually have the opportunity to invest directly through us. Why would someone do that? It does trade on the ASX, as we all know, under the ticker code of INES. You can Google that or even go to our website and look that up. But if you apply through our website as part of this offer, you don't have to pay any brokerage. So you need to do some research and see if that's going to save you. But you also don't pay any of the spread. So the spread is the difference between the buy and sell price. We're going to give you just the net asset value right down the middle. And that's a price that's determined as of the close on the 25th of October. And that's actually when this offer closes. So the offer started yesterday, Monday the 14th, and it closes 5 p.m. Sydney, Melbourne time on the 25th of October. It's very straightforward. If you want to actually invest, you can go to, I'll just jump to the next page here. You can go online and go to offer.intelligentinvestor.com.au/INES. Minimum investment's $2,000, but don't just wait to the last second because it's done by BPay. It's like paying a bill. So try and get that done as soon as possible. As soon as we receive your money, we'll then allocate you the units in the coming days after the close. And just mentioning that there's the flat fee of 0.97% per annum, and there's no performance fee with this. But what I'll do, instead of me talking about all that, you can actually listen to the person who is the portfolio manager, and that's Nathan Bell. Hi, Nathan. Thanks so much for joining us.
Thanks, Tom, and welcome everyone. Hopefully I'll give you more than 5 reasons to invest in the fund. But I was just saying to Tom before we turned on the webinar that when we did this webinar 12 months ago, I almost felt apologetic because the fund hadn't done much for the previous 2 years. And so it was a bit of a contrarian signal because little did I know that as I was talking, the market was starting to take off, and we ended up having a really good financial year. I think we did about 15%, which was just slightly above what the market did. So it was a really big year for market returns. So maybe it's not the best signal because I'm actually far more upbeat with the fund at the moment than what I was 12 months ago, because I was just frustrated that I felt like we owned the right stocks and we just weren't getting any benefit for it. And that's still been the case. I'm going to talk about the banks in a moment and our performance. But finally, just in the last 3 to 4 weeks, a bunch of long-held stocks are finally starting putting some runs on the board. And as this bull market starting to spread away from just the 20 biggest stocks on the market, the fund's starting to pick up. So, this is what I've been waiting for bloody long time now. It's probably 2.5 years for this. Since interest rates started going up. So it's been a long wait, but it's finally coming. And it's, I'm starting to get excited because it's only the very start for some of these stocks, as I'll talk about shortly. But as I always do with this fund, I just want to quickly take people through the reason that we launched this fund, because I think at the moment ESG funds have actually lost some of their luster because the returns haven't been so good. And I think also, just ETFs, just regular index funds are doing really well at the moment. So the whole ethical thing has just lost a bit of the buzz. And I've only got the report up until last year, but you can see in the table there, it's the RIAA. I might just take my glasses off. The RIAA do a report every year, and it just updates the returns from all the ethical funds out there. And up until a year or two ago, there was really strong outperformance, and it's slowly coming back. And I wouldn't be surprised if you add the last financial year in, when the report comes out, it would probably be next month. If that long-term outperformance is probably closed again, which is why people are losing interest in ethical funds. But this is really what I've been at pains to explain from the day we launched, is that there's nothing magic in the ESG filter. It's your investment process that decides whether you're going to make good returns and outperform or not. And I just can't say that enough. So when Ron asked me to go and gave me his thought about launching an ethical fund, I was skeptical. But I thought, actually, there is a way to test this. We can go through all the recommendations we've ever made in our subscription business over 20 years or 25 years now, and see what returns we got from the stocks that would have passed the filter and those that didn't. And you can see there the average return. And bear in mind, these aren't like a portfolio return, because a lot of these stocks were re-upgraded a bunch of times, but the numbers were clear. The ones that passed the filter had a 14.8% annual return, and those that didn't was only 10.1. So it was a massive gap. And the reason was, it's not because of the ESG filter, it's just because the ethical or the ESG filter essentially forces you to buy the highest quality stocks on the market. And so when we've stuck to the quality and we haven't compromised on the quality of the business, we've done much better than when we've bought those lower quality, cyclical, maybe some stocks with a bit of debt that we think can get through it, or their turnaround situations, all those sort of things. So, it was very clear that when we just stuck to our knitting and just stuck to the best companies, we got a better result. So that's really why we launched the fund. And it's turned out to be true so far, although, what are we, 4 or 5 years in? It's worked out exactly how we hoped it would. I'd like the returns to be a little bit more stable, but you don't get any choice in that. But just in terms of the filter, there's absolutely nothing special about our filter. It's just a general filter that's used across the industry, and it just takes out all the things you'd expect. I know we had a question about mineral resources.
That's right.
As a company, why is that? When we exclude fossil fuels, why is mineral resources in there? So it might be just a good example to go through. The iron ore miners are all past the filters, as far as I'm aware. I think what keeps BHP and Rio out, at least in the past, was their uranium businesses and their coal businesses. And BHP sold off the coal business. I'm not sure if it's all of it, but I think they've still got these tiny uranium businesses. So that was always what kept them back. So it wasn't actually the iron ore mining divisions. Essentially, they're just digging dirt out of the ground. The fossil fuels really comes into it when it's the oil companies, when you're burning the fossil fuels. So coal and oil are probably the two most well known. So mineral resources, it does have its own iron ore mine. It's a smaller part of the business compared to its main part, but the main part is actually just a iron ore crushing business. So in that sense, it's not a fossil fuel company. It just crushes the iron ore, but it does actually have its own iron ore business now, and a much improved one. So that's why they passed the filters. Although, we found better ideas than to have BHP and Rio anyway, but you just have to be comfortable that I haven't looked lately, but I think there's a tiny bit of uranium still in those businesses. And it's also similar with the banks. The banks pass the filters, but people might complain that actually, there's a tiny bit of the loan book that has been going out to fossil fuel companies. And so some people rally against that, but these are tiny parts of the business. So in terms of, fossil fuels in our fund, there's zero. And in fact, the only little part I can think of is Mineral Resources actually found some gas, which is a small proportion of its business, but it looks like it's going to sell that anyway. So what would have been not even barely a rounding error for our fund in terms of exposure, it's actually probably going to be zero very shortly. So again, there's nothing magic about the ESG filter. I think the one change that it'll be interesting to see whether it sort of gets industry approval, to put it that way, is the data center companies which use a lot of electricity. And we're now starting to see in the US that they're starting to worry about electricity supply, because these data centers just use up so much, with AI. So it'll be interesting to see, because we own a few of these, or recently reintroduced some of them. They're not massive positions, but it would mean probably a lot more if this was a international fund with Google and Amazon and Microsoft in there, because they do use a lot of that energy for the data centers. That's a massive part of their businesses. So, and they would have been core ESG holdings for international funds for quite a while, and they would have driven a lot of their returns, if not all of it. So, so that's an issue that's coming down the pike, but it's not one that's surfaced yet. So that hopefully that clears up at least how the filter works. It's very simple.
And it sounds like even there, Nathan, you had that the standards are evolving, and obviously you and your team, you're constantly reviewing and seeing whether or not it fits against those filters.
Yeah, and the important thing is that we can't bring any of our personal views to it. It's just the ESG filter is standard, and we have to take, whether we agree with it or not. It's just basically what it does. It just, we run the ESG filter on the ASX, and we get a list of stocks that we're allowed to choose from, and then we pick the portfolio.
Yep.
So I won't go too deep into our process. I think most people are familiar with it, and you can go back through these slides after the webinar anyway. This is another important point I like to make, is just that the best corporate governance, in my view, is having skin in the game. And so virtually all of the Australian holdings in the fund are owner-operated or have a big insider owner. I wish I had an update to these charts, but they're just the nicest charts that I've seen, even though there's lots of other research that shows this. But it only goes up to 2014, but it just shows you the outperformance in the US of founder-led companies. So, just think of Amazon and Google and Microsoft, which all have insider owners or big insider owners running them or involved. And then the left-hand side is really shows the benefit of the tech stocks over the last 15, 20 years. But on the right-hand side, you don't need to know the detail there, but it actually shows it's just across all industries. So this is a really important part of our process. In fact, if you don't really understand much about our process, the fact we're just trying to buy good companies at cheap prices, preferably with people running the business with all their own wealth invested right alongside us, right alongside yours. So the performance, you can see we got out of the blocks incredibly well. And then we've had a middling period since interest rates have gone up. And it hasn't been poor stock picking. It's more I've been frustrated over the last couple of years because I felt like we've had the right stocks and we've done everything right with this fund. We've barely had a mistake of commission. Johns Lyng was the latest one, but again, only small loss. We haven't had any major losses. We just had a lot of stocks, which are, because this fund is really a mid-cap and smaller cap fund, we don't really invest in many of the top 20 stocks, if ever. This mid-cap and the smaller stocks have just been completely left out over the last 2 years as index funds and ETFs, which I'll talk about in a second, have just been bidding up the 20 biggest stocks on the market. So it hasn't been poor stock picking. And if you were to throw the 10% back that I think the banks owe us to get even remotely back to fair value at the moment, then that since inception, our performance of 1% goes out to 3%, which is where it deserves to be, in my opinion. So the question really is, how do we keep the 3% going rather than the 1%? It's fine as it is, and a lot of fund managers will give their right leg for that outperformance at the moment, and that's after fees. But I don't think that's reflective of what the true stock picking has been in the fund. And you can be the judge of that when I go through a few stock examples in a moment. But the fund's going really well. And again, I think 10% is actually the minimum. If the banks actually have a hard time and they actually go back to where they were about 4 years ago, then we're going to get more than 10% back. So, and because the fund's only been around for 5 years, that's basically 2% a year we get back in since inception numbers. And you can see the last 2 years there. Basically, that's all the banks. Frustrating. So when did the banks become AI stocks? Well, I don't know. Maybe you can tell me, but the banks have never been this expensive ever. And the frustrating part is they've never offered less growth ever. So it's technical factors driving this. We know what it is. It's just ETFs and also a bunch of foreign money in particular and institutional money that's just going into the banks because it has to, or it doesn't want exposure to China. So if you're on my numbers, if you were to buy an equally weighted portfolio of the 4 big banks at the moment, the best that your total annual return would be over the next decade would be 5%, and that includes dividends, not franking credits, but dividends. And that's assuming everything goes well. If there's any hiccup in any of that, or if interest rates go really down and crush the profit margin, net interest margins further, then they'll go back even further. So it makes little sense on fundamental view. Like even the institutional analysts have price targets 30% or more below where the current share prices are, and they're normally the most bullish in the market. So we'll get that back. What matters to us is to make sure that we've got the right stocks, so we don't just get that back, but we outperform the stocks we own. This is a really important point that's dominating markets now. The ETFs have taken over. I think they're bigger in the US and Australia now than what active management dollars are in the market. So we're a declining bunch. Which should mean theoretically that there's more opportunity, and that will be the case. But actually getting that reward for the opportunities is a bit different, because I think what you used to see was companies would have their earnings forecast for the next couple of years, or analysts would do that, And sort of as you got closer to, those future growth earnings or higher earnings, you'd start to see the share price push up, to reflect that. And you're seeing less of that now. What you're seeing now is because a lot of these dollars, are based on algorithms, they actually need to see the numbers reported before they start pushing the stock price. And you've seen what's happened with RPM Global. And, this RPM Global is perfectly what we want to see from our small cap stocks. And I'll talk about small caps later. But RPM Global is off the radar, $250 million business. We bought it, it's doubled, and now it's been included in the ASX 300, and now indexes are starting to buy it. So it becomes more liquid, and then it doesn't take up room in our very small basket of micro caps that we can own. And it becomes a much larger business, and that's why it's part of the reason why it's the largest position in the fund. So we can take advantage of the opportunities that those ETFs are leaving us, but the actual getting reward is taking longer than it used to. You can see this chart here. You don't need to know the details, but this is basically just looking at the US market in the different sectors between large cap and small and mid caps. And you can see that small and mid caps have just been left way behind, and we're only just starting to see that recover at the moment. And you can see that in individual stocks, but you can see it across the market as well. So, we're at basically 20-year lows for mid cap and small cap valuations versus large caps. So I don't think it's going to be the case that small cap and mid caps are all going to go up and meet the valuations of the large caps. It'll be somewhere that they meet in the middle, where the bank valuations have to come back down to something normal, and the small and mid caps will meet them in the middle. Sorry, I thought I had one more. So I just want to go through this slide here. I'll just read this straight off the slide because history doesn't repeat, but it does rhyme, and I'm really hoping this is what we're in for the next 3 or 4 years. So at the moment, the top 5 combined market cap, sorry, this is the US market. The top 5 combined market cap is now 3.3 times the size of the entire Russell 2000 index. So the Russell 2000 index is 2,000 small companies. That is more than 2 times the level in 1999, 2000 at the height of the tech boom. So, crazy period for valuation disparity. So what happened after that was from 2000 to 2006, small cap value had annualized returns of 16%, while the S&P 500 was closer to 1%, and longer duration equities generated negative annualized returns. So I don't expect we're going to get exactly those numbers, but we're going to get the same trend. And as I said, you're starting to see that now, and I'll talk about that with some individual companies in a moment. So the one big change that we made in the fund more recently is that it was just getting so hard to find stocks for the fund that not only passed the filter, but actually passed all our fundamental hurdles as well. So hopefully all investors have received the notice a few months back at least, and know why we made the change. But the alternatives that we were left with, none of them were appetizing. All they did was increase risk. So the smartest thing to do was the only one thing that actually allowed us to potentially increase the returns of the fund and reduce the risk was to add a sleeve of international holdings to the fund. So we can now hold up to 30% of the fund in international listed stocks. So we've simply, for anyone who's been following our select fund, we've just pinched half a dozen or 7 stocks out of that fund and popped them straight in here. There's no new ideas we don't already own in there. We haven't got time to go through all of the stocks, but I'll just quickly tell you a sentence on a few of them. And if you've got any questions about them, we should have plenty of time in the Q&A to go through them. But Fairfax Financial is basically the Canadian version of Warren Buffett's Berkshire Hathaway, run by Prem Watsa, potentially trading on a single-digit earnings multiple. It went through a tough period where Prem put on all these hedges that proved very expensive because he thought basically GFC 2.0 was going to come in the mid-2000s when stocks got expensive, and it never came. And so it was really, really expensive, like billions of dollars in lost money for a financial accident that never happened. And people just left the stock for dead. So it really suffered this sort of almost a decade in the doldrums. And only over the last couple of years, it's gone up about 5-fold now from the bottom. Unfortunately, we didn't know it that early, but it's worked out nicely so far. And Prem's got his mojo back and things are going well again. So this is the business that ticks all the boxes. It's cheap, it's quality, it's reliable, insider owners with their own family wealth invested right alongside yours. So that's a classic II holding. CME Group is basically, think of a much better version of ASX. It's, again, founders at the helm, built by acquisitions, but it owns a lot of derivatives exchanges, particularly interest rates. And so these are actually a growing business, unlike the ASX. So far superior business and available at not a pretty similar price, actually. Might even be cheaper. Visa, I think everyone knows Visa. Visa's, if it wasn't for the risk to interchange fees over time, then this would probably be 10 or 15% of the portfolio. It's just been an incredible business along with MasterCard. It ticks every box. The problem is it's just, there's always risk with every business. So you've always got to be humble and not overinvest in any stock. And so Visa's going through some DOJ stuff in America at the moment about its debit card fees, but it's been through this before and come out the other side just fine. And even if something happens, it doesn't mean the end of the company or anything like that. But the reason it's only a 5% holding is because you never know, and maybe it gets bad news and it gets cheaper, and at least it gives us a little bit room to buy some more. But you can just see the quality of these companies. Like, it's far better than almost anything we can get in Australia, sort of outside probably the, 7 or 8 maybe best business in Australia, maybe even less. And just quickly, HDFC Bank is basically a small position we've got. It's very cheap. It's an Indian bank, grows like at numbers that just look ridiculous next to our banks, and it's got a very long runway over the next century as India continues to modernise and bring people out of poverty, and surprisingly cheap. And I'm never quite sure why that is, but I always keep it as a smaller position, because if it does what I think it will do over the next decade, then it will become a large enough position with the earnings growth. And Rightmove, as the last one I'll mention, so we can move on. But you would have seen Rightmove in the news recently with REA Group trying to bid for it. It trades at less than half the value of REA Group. It's the UK equivalent of REA, but it's not quite as good a business. It's a different business model, but it's less than half the price. So we think this is an awesome business, trading a bit over 20 times earnings, cash on the balance sheet, buying back shares, good dividend yield, all the things we look for. So, English stocks are really have just shrunk as part of global portfolios. No one's interested in buying UK stocks, but so that's part of the reason why it's cheap. So that's the only big change we've made. But just in terms of that trend I showed you on a few slides ago between the small and mid-cap stocks and how their valuations are sitting versus the large cap, these are the names that we believe are going to help really drive the outperformance of the fund over the next 5 years. But I just want to make it very clear that when I say they're small caps, aside from Frontier, the rest of them are mostly billion-dollar business or multi-billion-dollar businesses. In the US, I think probably anything under a US $10 billion market cap is considered small cap. In Australia, depending on who you talk to, it's probably 1 to 2 billion. But the mid cap is really the sweet spot for stocks in Australia. That's where you get the best returns with very well-established businesses where their founders are still high energy, still running the business, excellent balance sheets, and still got plenty of growth in front of them because they haven't matured yet. So that's really where this fund is typically invested. But what we want to find is the next mid-caps, or the next mid-caps that can become large caps. And so, you may not be familiar with some of these names, but RPM Global, I've talked about quite a bit over the last few years, and finally the market's cottoned on, and now it's been included in the ASX 300. So you're seeing a lot more shares being bought. But it has about, so it's a software company. It went through a very long and expensive switch to a software as a service company. The market really hadn't picked up on that, or it's just too small and people wanted to wait to see the results. It's finally got there. It's just signed all these new frameworks with what they call global agreements with some of the three of the biggest miners around the world. And that makes it much easier to sell software. And basically, it means you've got an automatic foot in the door. And that's what they'd been missing a couple of years ago, particularly during COVID, when they couldn't go out and talk to these people. So this business is ticking every box for us. My guess is it's probably worth at least $4 a share to an acquirer. It's trading around $3 at the moment, but it's got cash on the balance sheet, buying back shares, everything going the right direction, and it's got about 4 times its current sales already signed that will flow through as sales in future years. So the business couldn't be any better placed if it tried. What's actually got me really excited recently, though, is finally MA Financial has been picked off the mat. It's been just sitting there for about 2 years doing nothing. And then finally, in the last month, it's moved up about 20% or something. My guess is it's trading on about 12 or 13 times 2026 earnings. And because it's on a calendar year, theoretically, the market should be looking at those numbers, assuming they're coming through within 12 months. So I really think this stock should be trading at $9 or $10, not the $6.20 or 30 or whatever it is trading at this morning. It's doing everything right, and the earnings should grow about 50% within the next sort of 18 months. And again, as long as the bull market keeps going, these are the sort of stocks that are going to flourish. And it's just huge operating leverage in these businesses where small increases in the revenue have big increases on the bottom line. I'll show you a chart in a minute too, because MA Financial is one I want to talk about in a bit of detail. PWR, we're actually going up to the annual meeting in a few days and doing a tour, but it's got a new business that we think is going to be much bigger than the business it's well known for, which is cooling systems, which are in all the Formula One cars. So it's investing heavily at the moment, and the share price has come off a little bit, so we bought a little bit more. But it's a company, again, classic II stock, insider owner, great financials, a bit off the radar, increasingly being known as it gets bigger, but long growth runway in front of it. It's got decades ahead of it. Eagers Automotive is another recent one. Again, I've got some slides for these, I'll talk to in a moment. But Eagers, actually, why don't we do that? I might just go through that.
Yep.
So, sorry, I'll just go back 2 seconds. This was a slide I meant to show you. This was the most important thing is, again, this is just a follow on from that small cap versus large cap. And it showed around December last year was when everyone thought interest rates were going to go down. And you see all of a sudden the small cap market just took off. And then all of a sudden, inflation came out a bit higher. I think it was in March. And then all of a sudden people started worrying about higher interest rates. And then all of a sudden the small caps lost interest again. And so what you've seen in the last month is you started to see that renew. I haven't got an update chart yet, but hopefully in 12 months, I'll be showing a similar chart with all these stocks I'm talking about at the moment going up. So this is why I'm actually starting to get excited about the fund, because it's been a long wait and we're only finally just starting to get the rewards, but these stocks are still very cheap. And nothing like if these stocks we own actually got a apples to apples valuation like the large cap stocks, the fund would probably go up 30 or 40% instantly. Yeah, we don't expect that to happen, and it's not going to happen, but we don't need them to. But it just tells you how much value is there to come. So quickly, just on MA Financial, I talked about the valuation, but basically this business is a mini Macquarie, founded by Executive Vice Chairman and 20% shareholder Andrew Pridham, but he has less to do with the day-to-day these days, and he's really in not so much an executive role, but just a guidance role, and still heavily involved. But it's really the two co-CEOs that he started with, which Julian Biggins and Chris Wick, who own about 4% of the shares each. I think they're worth about $20 or $25 million, and I'm sure they want that to be worth hundreds of millions of dollars over time. And they're only about my age, and even though I feel old, I'm sure they feel energized at their age. And so they should have another good 10, 15 years in them at least as they expand the business. And this is one that could be worth multiples of its current value over time. So it's been morphing from a boutique investment bank to an asset manager and more of a lender at the moment, if you've seen some of the recent announcements. So it does add a degree of risk, but I just think they're well and truly compensated for at the moment. And I think as this bull market goes on and the economy improves a little bit from lower interest rates, this is the sort of company that could go up, the stock that should go up rapidly. And you can see the difference between having a shareholder-friendly board and having the people actually running the business who own the business. And that's the dividends over the years. So even when earnings haven't increased that much, they've still increased the dividends because they've been able to. They're fully franked dividends, growing rapidly. So I'm really hoping for the fund, this is Pinnacle 2.0. So for people who've been following the fund, that Pinnacle was, I think, went up about eightfold for some of the shares we bought. And we recently sold that and we locked in our big gains. The dividends went up something like 50% a year for 4 or 5 years. Absolutely perfect stock, slightly different business to MA Financial, but ticked all the exact same boxes. Owner-led, owners with skin in the game, lots of growth in front of it, great balance sheet, buying back shares, paying dividends, doing all the things we want them to do. So hopefully this is a repeat. So this is Eagers Automotive. This is one that we probably should have discovered a bit earlier, but I think if you screen this and look for the sort of companies at high profit margins and low debt and high ROE and all that sort of stuff, it wouldn't tick a couple of the boxes because of the debt. But actually, the debt's not it's not all bank debt like a lot of, unfortunately, Australian companies use. It actually just it's vehicle debt, which is nowhere near as bad doesn't risk the financial position of the business like bank debt does. So it's the number one used car dealer in Australia, has about 13% of the market. Actually goes back about 110 years. I think was the first stock listed on the ASX, or one of them. It's never missed a dividend since listing in 1957. Has heaps more tuck-in acquisitions it can do. This is not even though this company's been around forever, it's not what you might call an ex-growth company like the banks, for example. It's not struggling to grow earnings. Big insider ownership, and it's cheap. And it's probably trading on a PR of about 12 now, if it's gone up a little bit in the last week. And, and a 7% fully franked dividend yield, which, again, it just shows that trend for these insider owners that they want a stake in the business, and they want to use the dividends of the business to live their lives, which is perfect. That's absolutely what you want. You don't want them selling shares and ending up with a tiny shareholding, so they don't care about the business anymore. So, again, ticks all the boxes for a classic II stock. And the last one is MinRes, and I apologise to anyone who's been following the newsletter and maybe heard a bit too much about MinRes, just because the share price has been wild, and it has had a big impact on our funds because it was one of our larger holdings, and because we made about 30% on it when it went from 60 or 70 to 100, and then it went back down to 52, then it went back to 70, and then it fell to 30, and now it's back to 50. So it has been swinging our performance around a lot. But I spoke about it earlier. I think what's misunderstood, or at least one of the parts of this business is misunderstood, because it is a really complex business, is that the crushing business, the iron ore crushing business, is just one of the best businesses in Australia. It's just so simple and so profitable. And the only issue with Mineral Resources at the moment is, aside from the lithium bust, which has been far more severe than anyone probably thought, is that it's just been caught out after expanding its Onslow iron ore mine, which is going to drastically reduce the cost of its iron ore business. It just got caught out with bad timing with the debt that it used to build that business and to expand its lithium business. But it doesn't have bank debt like most Australian businesses. It actually raised its debt in the US credit market. So time is on its side. And as long as it's already sold 49% of the road that leads to Mount Onslow, which is an infrastructure asset, to Morgan Stanley. So it just got that money recently. So that'll help reduce the debt. And once it gets the Mount Onslow mine running up, I think June next year, they expect it to be doing 35 million wet tonnes. Then that should actually increase the cash flow and start getting the debt down, and then it'll get past this recent fall. And I think that's the only thing really weighing on the stock at the moment. If you could sell these gas assets as well, that again reduces the debt. But this is a stock that is trading around $50 at the moment, but it could be $100, $120 plus stock. If we actually get lithium back to $1,400 or $1,500 which is what the recent Arcadium deal was done on, which Rio just recently bought that. The long-term price seems to be assuming around $1,400 to $1,500 for spodumene. Then maybe you're talking about $150 stock as the mining services business grow, and the lithium business is actually minting money. So there's a lot going on. It's just been bad timing at the moment, where iron ore price has fallen and the lithium's fallen far further than anyone thought. But it doesn't have the pressure that a lot of other businesses to raise capital, which is what all the shorts were betting on. So time's on its side at the moment, and hopefully over the next 12 months that we sell the gas assets and Mount Onslow runs up to nameplate production, and all those earnings start flowing through, and hopefully we're back at $100 share price before too long. So again, there's a chart of the lithium price just been absolute carnage. There's still too much supply out there, so it's going to be a bit of a slow recovery for lithium. So the important thing is, I think the past performance of the fund has been excellent. I don't think we're getting full credit for it, just because of what the banks are artificially inflating the index returns at the moment. When that goes back, I think it actually shows the true form of the fund. But what's most important is how are we actually going to keep the outperformance going from here, and hopefully those stocks give you a bit of an insight, because MA Financial and MinRes can easily be worth twice what they're currently trading at over time. And Eagers Automotive, not many stocks where you've actually got confidence in the business trading at a 7% dividend yield in this sort of environment. So at some point, I think the main thing with Eagers is actually people are just thinking that the profit margins on used cars are still too high post-COVID. But if the company can prove that that's not the case, then you would think in this sort of market where valuations are so high that maybe it does put on 50 to 70% and get that dividend yield to something more like 4 or 5%. which seems more fitting with where we are in the market at the moment.
That's excellent, Nathan. I'll give you a bit of a break to rest your voice there, because we've got some really good questions that have come through, and even a couple that I can help with in terms of the admin. There was a question we received before the webinar just from, let's have a look, from Salamar. Will the raising not dilute existing shareholders? Is it truly more about scaling up to increase fees? At what size does the fund become less nimble and liquid? The other thing too is, and this will tie into some other questions too. Greg asked, has issue 1 allocated 30% to international shares? So I'll just help Nathan set it up here. Basically, even though we've had the initial offer all those years ago, and we've had regular 1-year secondary offers, it's still the one fund. So all of the international exposure has been applied to the fund itself. So if you got it at the very first, you still have the same kind of units with the underlying holdings as someone who might take up this offer during this period. It doesn't dilute. We use a market maker, and we can create more units, and their job's to go out there and make sure there's enough liquidity in terms of units around, and they can buy some more, or they might redeem some more and unwind them. So there's never a problem with any kind of liquidity or dilution. The fund actually trades at its net asset value, which if you go to the website and look at the actual fund page, you can see the estimated net asset value, which we publish, but we also publish a daily one, which is continually being published since the very start. But Nathan, talking about that, I mean, someone was talking about the fees there. And there's a question from David as well on the live chat, just talking about, how much traction so far. I know you touched on the international shares, but how much traction have you sort of gotten so far by having this allocation of international shares to the fund?
Yep. So I think it's about half a dozen questions there. So if I miss something, mate, you'll have to remind me. So
definitely will do.
So just in terms of these secondary offers, all of our funds are very small at the moment. Like this fund has less than $70 million in it. So, we're not making out like bandits. This isn't a particularly profitable fund for us. Like we need to grow them much bigger before we actually start making some decent money out of them. So the easiest way for us to grow our business, and I think it's by far and away the best way, is to do these webinars, because it's an efficient use of my time. Because if I have to go out knocking on doors, week in, week out all year, then ultimately it just means the performance of the fund suffers, and then you're in a self-defeating cycle, because you've never got the outperformance that people want. And the thing I like about these best is that most people want to eyeball the portfolio manager before they invest. So that's really what this secondary offer is about. It's about, you can actually come in, ask me questions, see how I'm feeling about the fund, and get a proper detailed analysis of how the fund's going and what my expectations are for the fund. So that's why we do it. I do these webinars every year anyway, even if we didn't have a secondary offer. So it's just easy for us to make that an appendage. And again, I think it just shakes a lot of people just out of their apathy. They think, oh yeah, I should invest, but just don't get around to it. Even though you can buy the units on market instantly. They like to see someone personal presenting to them and telling about them, so they have a much better understanding of what their expectations should be. So that's one reason why I like it. The other reason I like it is because no one's going to give us any money if we don't perform, and that's what we're here for. That's why our funds are different. It comes with the highs and lows. You've got to go through these protracted periods where we're going to underperform. Like it's really frustrating for me because I feel like we've done everything right in this fund from the get-go. We've hardly made a mistake of commission. The biggest mistake we've made by far was not buying WiseTech. About 4 or 5 years ago, when a short report came out questioning its acquisition strategy, and the share price fell below $12. So it's been a 10 bagger since then. So they're the mistakes I hate making. If we just lose 1% on a stock that doesn't work out, who cares? But missing, those most mistakes of omission, they're the killers. And I can't say that enough. I say it much for my own benefit as anyone else's. And that's what Charlie Munger and Warren Buffett were always trying to tell you. And because there aren't many of those stocks on the ASX, you just can't afford to miss them. So, I'm complaining at the moment, thinking that the banks owe us about 10% of performance. But if we just had to put 2% in WiseTech, then that 2% would be worth 20% today. So, so they're the things I focus on, not buying the banks. So in terms of the size of the fund, I think what the fund has until it probably gets to maybe $700 or $800 million is the opportunity to outperform by over 3% a year. And because there's no performance fees on this fund, that makes it a little bit easier than a lot of other funds that have performance fees. So once you get past that, once you start getting to the billions, I still believe you can outperform by 2% a year if you do everything right. But you can't get the 3 or 4% outperformance. So that's what we're really gunning for while the fund's still in that sub $500 million. Now, it doesn't mean we're going to do that, even though we've done it before and we've done it with other funds. And we had a golden period between 19 and 22. It just depends on, what stocks are available, what the market's doing, valuations, all that sort of stuff. But that's the real advantage when you're in a nascent fund, when the fund has still got less than $500 million, is you always do have that opportunity of, the 3% plus outperformance. But the thing with our funds is because they're all listed ETFs, they have very strict guidelines from the ASX about your liquidity. So we can't own, we can own probably one microcap, and we can't own 5. And so what it means is we have to really make sure that we own the right, 3 key small cap holdings, because that's about all we can own. And then what we want, when things work out perfectly, is that those small caps become mid caps, and then that allows us, it frees up the room at the bottom of the portfolio to find the next small cap. So there's only so much we can do with the small caps. This isn't a small cap fund, even though I've tried to show you some small and more mid cap stocks that I think are going to be great stocks for the fund and are much cheaper than any of the top 20 stocks, that's for sure. But because I think they're going to be, as a group, a key driver of the fund over the next 5 and 10 years. Have I missed anything, Tom?
I guess just even bringing it back to the international exposure that's been added.
Yeah.
David's got that question there on the screen, just saying, how much traction have you achieved so far? And I know it's only fairly early; it's been added to this particular fund, but have you noticed anything as of yet?
Yeah. So when we made the decision, only got one complaint. I think everyone else was positive. I think the one thing you have to remember that it does introduce is a bit of currency volatility. So we saw that in the last quarter, where I think about 1.5% of the underperformance was just because of the currency. Went from, I don't know, I think 64 to 69 or 67 to 69 or whatever it was. We can hedge that currency, but I don't generally want to put on the hedge on the currency when we're within 10% of the long-term exchange rate with the US dollar. As long as we're in that bound, I don't want to pay for it. But when it gets outside of that, I definitely want to put it on, because you don't want years of underperformance or years of performance wiped out just for currency risk. And, I'm not going to sit here and think I can pick currencies. It's an impossible task. But if the gap just gets too wide, where investors are going to get penalised and our returns are going to start reflecting currency rather than the underlying businesses that we own, then that's what we'll put on the hedge. In terms of traction, like, has it been an increased sales option for the fund? I don't think so. I think just people have lost interest in the ethical fund, and I think that's because a lot of the ethical funds that were launched didn't have very good investment processes to start with. Obviously, I'm biased, but obviously I don't think that's the case with ours, and I explained why. The only reason I went along with our ethical fund was because it just shows if you stick to quality and you stick to value and you're disciplined around valuation and you look for those insider owner businesses, you can outperform. And we've got no excuses for underperforming. And I, as I said, I don't think the performance of the fund at the moment since inception does justice to actually the stock picking, but it will soon enough. I don't think the banks are going to stay this expensive forever, because the money that's in there is not going to sit around for the next 10 years at best earning 4 to 5%. It's just not. As soon as it feels there's a better place to go, all that money's going to wash out and the banks will go back to where they were at minimum 10 months ago. And in terms of the international stocks, they've actually gone well so far. I think all of them are up except one's down a little bit. So that's off to a good start. It was actually hard trying to stick to the 30% limit. We probably could have gone a little bit higher, but I think at the end of the day, most people want this to be an Australian fund, and I want this to be an Australian fund, because if you want international exposure, then you go to IISV, the select fund, because essentially it's almost the opposite. Like the ethical fund is an Australian fund with stocks that pass the ESG filter with a little bit of international, and select is basically an international fund with a little bit of the best of our Aussie stock picks.
I think you just answered that question from Sal on the screen. That's perfect.
Yeah, let me just quickly, because this is a good question, I think, for all of our funds, because sometimes people send in a question when I've written the quarterlies, and they say the quarterlies are the same if you made a mistake. And so just to be clear, so the way I set these funds up is that what you ideally want from all your funds is you want them all to be cheap, all to be the best 20 stocks on the market, with heaps of growth in front of them, great balance sheets, all to be insider owner led. So all the things you're looking for, and you want them all to pay high dividend yields. So that's your starting point. So then all I do with the 4 funds is then I just work out what's not applicable. So obviously with the income fund, we always try to match the minimum yield of the index with the fund. So that's got to be taken into account. With the ethical fund, obviously everything has to pass the ESG filter. But you do have an overlap of core holdings, CSL, Mineral Resources, RPM Global. There's only so many great companies trading at great prices at any one time. So you are going to see a lot of overlap. And I don't want to just try and write the quarterlies slightly differently, even though I'm saying the same thing. I just want them, I've got 4 to write these days. So, they do read quite the same. But, if you have been following the select fund, then the holdings in the ethical fund are just the same. And it gives us a much better chance of keeping up that outperformance. Whereas, if we just had to increase the portfolio sizes of the stocks we already held, or we just had to started buying more expensive stocks, that would have ended up being a disaster and we've underperformed. So I think that was by far the smartest and easiest option.
That's excellent. There's another question here as well, talking about, I guess, Macquarie. Macquarie's an interesting one, isn't it? Because it was one that, was it Angus was covering, and he put the recommendation into sell, or was it Graham? I can't remember, but...
Yeah, so Nick put a sell on Macquarie,
Nick.
and I put one on CBA. So what I'd say, Jeff, is they are going up, but it's got nothing to do with fundamentals. So if you follow that question right through, so what are you actually really asking? Are you saying we should just buy them anyway because they're going up? And then when all of a sudden all that hot money disappears, and all of a sudden these stocks are 30% down in a few months, was that the smart thing to do? Or obviously not. But the last thing I want to do now is jump on board now when we know the absolute best we can earn is only 4 to 5% after we've suffered all the indignity of not owning them. The last thing I want to do now is basically lock in that loss essentially against the index. So, CBA, like the best you're going to make from that is like 4% at the moment. That's with the dividend yield. Like it's just incredible. It's, it's not like I've looked at the banks and said, we're too good to own the banks. We can come up with better. Like if they're cheap enough, I'll buy them. But I just thought we could do better. And I think it'll prove when, one of the reasons why we had that extraordinary period between 2019 and 22, where basically all our funds, the 3 funds we had at the time, these 3 Australian funds, they outperformed the market by about 35% over those 3 or 4 years. And the only reason they did that was because we didn't own the banks. If we had owned the banks just at market holding sizes, we would never have done that outperformance, and we wouldn't be sitting here today having this conversation. We wouldn't have the outperformance we've got. It'd be way behind. And we might all feel good that, hey, we own the banks, but no one's going to be putting any money to this fund because we wouldn't be outperforming. So you've got to pay the price, right? For anyone who follows football, Yabby Jean's quote from the old Hawthorn coach, like you've got to pay the price. And the price for outperforming by 2 or 3% over time is that you're going to go through periods where your stocks are just not performing. And there's really no reason why Aussie Broadband and MA Financial and a bunch of others that we've owned haven't been deserving of much higher multiples than what they have over the last 2 years. It's just simply that the market's dominated by ETFs and more passive funds, and the money can't go into those smaller caps because they're just too small. They've got to go into those top 20 stocks. That's why they're just chasing themselves up. But I think what we'll end up seeing, and I don't know when this is going to happen, and I might be wrong, but for those who remember, my reading of the history in the 1987 crash was that one of the reasons that the market opened up 25% lower instantaneously I think it was Black Friday on the week before, and then it was I don't think it was Black Monday or whatever they called it in Australia on the Monday, was because back then they'd invented what they called portfolio insurance, which was basically an algorithm that said, okay, if your portfolio falls by 10%, then just sell everything basically. And that's what happened. Like the selling just beget more selling, beget more selling, beget more selling. So I assume that's what's going to happen next time we go into a bear market or a downturn with all these ETFs and passive money. They're just going to fight with themselves to sell stocks, which should be great for us. But what I think it will probably mean is the market's going to probably fall much faster than perhaps we used to. Like it probably won't be I don't know when this is going to be. It might be 3 years, 5 years, 7 years, who knows? But at some point we'll have a downturn. And that selling could be really rapid. So it's you might sit here and go, okay, Nathan, just buy the banks. They're going up. The ETFs are buying them. That sort of demand, if you like, is there, and it's growing because we've got superannuation. 10% every year that goes into these banks and these bigger stocks. But you've got to wear the other side of that as well, because obviously you're not going to sell them. If you haven't sold them already, you're not going to sell them because they're already overvalued, way overvalued. So that means you're going to hang on to them. So I don't see any point in hanging on to them now and risking a 30 to 40% fall in those stocks. That only gets them to remotely fair value. If they get to if they actually got back to a 9 or 9.5% total return, which is the long-term return of the market, then they'll need to fall more than 40%. All right. So that's about a third of the market. So 40% of the third of the market, that's nearly 15%. So that's potentially there for us as a tailwind. But we had that tailwind for 4 or 5 years, and we just haven't had it for the last year, which is screwing up our numbers. But it's not going to last. And when it goes back, we really want to make sure we're on the other side of that.
I'll give you a bit of a break there too, and because Jeff's got another question, just talking about does the fund provide the complying reporting for self-managed super fund accounting? And yes, it does. It provides the AMMA tax statements that are sent out, also reported to the ATO. So it does the self-filling on your tax statement when you're filling it in. So they get sent out automatically. Plus, you can go to the share registry, and we use Link Market Services for all of our intelligent investor funds. And it's a place where you can go to and download reports, income reports as well, etc. And check out your dividends, whether you're getting them reinvested, because it does have the dividend reinvestment option there, the DRP. If you want that put back into the fund, don't forget to turn that on. Or if you wanted it paid out, just make sure the bank details that are inside that are there as well. Because when you're actually applying, even through these offers, if you've got a HIN, a holder identification number, so that's your CHESS sponsored like brokerage account, like with CommSec or NabTrade, you can actually have your units in this offer sent to your brokerage account. So that's nice and easy.
There's a question there, Tom, from Ryan, which is a good one.
That's my next one.
Any differences and concerns for MA Financial with two of Andrew Pridham's kids slithering up the org chart? I love that. Slithering, a great word. Look, it's interesting. It's a funny thing about investing, right? Is you can always have these rules, and if you just stuck to the rules, you would never actually make any money. Because what happens is you just winnow stocks down to a point where it's got to tick every box, and therefore that really only happens in a massive bear market, and which you're probably too scared to buy stocks in anyway. So you're always, the key is about bending the rules, because no stock ticks every box. And part of me doesn't like that you've got kids coming up in a business, but then you look at ResMed and go, well, that's pure nepotism where the son is taken over from the father and it's gone from strength to strength. And then I look at Fairfax Financial, which I spoke about earlier, and the son there is primed to take over from Prem when the time's right. He's been very busy across the business for a long time now. So I think it's the same thing as always. It just depends. It's the answer. If they're not very good at their job and they were pushed up to senior positions, then obviously you'd be worried about it. But they're not in those senior positions yet. Another one's just like James Packer inheriting Kerry Packer and Frank Packer's business before that. Are you happy that James took over those business? Well, no, because he's just a poor soul of a person at the moment, and he just and I feel for him. If you ever sort of read about the history of the Packers, it's a tough family to grow up in. But yes, it is a concern that if he was running the businesses because he really just didn't get the joy out of it, I don't think, anyway. And it's tough being in his situation. Whereas for other businesses like Fairfax Financial, Prem Sun pretty much goes under the radar, and no one's really even heard of him outside, unless you go to the Fairfax sort of Berkshire event every year. Like, you wouldn't have even heard of him. So again, it just depends.
I was just going to quickly show people, because we usually get this question, but it hasn't popped up today. But a lot of people always ask us what's inside the fund. And if you're an Intelligent Investor subscriber, you can actually go onto the website and see the model portfolios and see what's being held inside them. But they're also published to the ASX. And the most recent one was the September portfolio update, where a report's given, I think even 4th of October, and it just shows the holdings inside. I'll just see if I can get that up on the screen for everyone, because the other question I've got here that was given from, here we go, from Des, is there an upper limit for a single holding? So I guess he's asking if there's a max allocation size for an individual holding.
Yeah, there absolutely is. It's 15%, but I've never managed a fund where I think the largest by far I've ever had any one stock was BHP, which was at market weight a little while back in one of the other funds. I think it was like maybe 12% there at one point, when it went up to about $50, and then we lightened the load there. But that's a fairly unique situation, because I actually deliberately was trying to hedge that position. I didn't want to be short BHP in the income fund at that point in time. In terms of, I wouldn't, like, I've been selling RPM Global every time it gets above 8% of the fund. It's a really tough. It's one of the tougher part of the jobs, I think, to get the balance right between having a concentrated portfolio where you're allowing your winners to run, but also keeping the risks in check. Because if you're selling too early, like, because we don't own a lot of stocks, when our stocks work out well, we really need that benefit. Because if we're missing too many stocks, then we're just going to underperform, because we don't have that many other stocks with the same sort of potential. So we really have to maximize when we get our stocks right. So RPM Global, again, across all the funds, I just keep trimming at $8. But when it's above 8%. But the reason, it's not pretty usual, I would have thought, where a $600 million business was a fund, an all-cap fund like ours, at the largest position. Some people might have Berkshire Hathaway as their largest position, and we've got RPM Global. But then if you go down the list, we've got Visa, which is one of the biggest companies in the world. CSL, these are massive companies, hundreds and hundreds of millions of dollars in market cap. But RPM, because it's got no debt, lots of cash, it means there's going to be no balance sheet issues. So if the earnings fall, it's not going to have to raise capital. It's not going to be one of those dire sort of situations. So that's the number one thing. If you've got debt problems, then you're never going to have 8% of your fund in it, I would have thought. It would be a pretty unique situation if it did. And you want a very clear plan for that debt going down. It's probably the most important point. So maybe that's MinRes. But the other thing about RPM Global is, at the moment, it's got about $60 or $70 million in total revenue, but the subscription revenue that just keeps coming in year in, year out is about 45 million, and it's got 4 times that already signed. So that's like almost money in the bank for the future. So that money is that other $160 million of sales is already signed and is coming through. So plus we've been added to the ASX 300 now. So it's all those reasons why I've kept that at 8%, and I still think it's worth $4. But if it got to $3.50 or $3.80, I don't think it'd be 8% anymore. It'd be 3 or 4%.
And I guess we're getting down to the last few moments, and there's probably the last 2 questions that we've got, because we've covered most of them. And it's just, I guess, like Jeff's asking here, what's the projected performance for the next 12 months? But the other question that we got from before was from Daniel, and he's saying, what's your highest conviction investment on a 5-year outlook?
So if I knew Jeff, I wouldn't be sitting here, that's for sure.
You'd be on holiday somewhere.
I don't know what it's going to be. Like, my aim for the fund is always, I want to outperform by 3%. That's what I'm personally always aiming for. I'm never personally happy unless we do that. If we do 2%, then that's fantastic, because that's basically the most that any fund like a vanilla fund like ours does. Even the best funds out there struggle to do that once they get large. So that's what I'm always aiming for, and as long as we're doing that, I'm happy. And if it gets below that, obviously just keep working, be patient. But we've done that for a long time. Like Intelligent Investor's 25 years old now, so and we've got no excuses. We can buy some small caps. We've got more experience as a team than we've ever had, and the fund's only got $70 million in it. So we don't have to buy the banks. We don't have to buy BHP and Rio. We don't have to be stuck in that stuff. We can just pick and choose what we like of the best of the mid caps and apply our process. So that's how I think about performance. Sorry, what was the second one?
And it was just from Daniel saying, what's your highest conviction investment? This time, though, on a 5-year outlook. So is that even harder?
Look, do you know what happens as soon as high conviction is mentioned? You're biased, and you're probably wrong.
Yeah.
I just try to think in 5 years, what's a business that could be way bigger than what it is today? MA Financial is a standout. That could be much bigger. PWR is another one. If this new aerospace business takes off, a lot of that, it's got a lot more factored into the share price than what MAF does. But just in terms of business size, it could be much, much bigger. Mineral Resources expanding all parts of its business. So that's going to be a stock that, as long as it gets through this period, without having to raise capital, and the lithium price comes back and all the rest of it ramps up Onslow, then this is a business that could be in the top 20 stocks at some point. They're probably, that's why I talked about those stocks. I think they're the most interesting, and they've got very clear growth plans that are really just doing what they've already done. They're not acquisition led. They're not trying to buy other businesses, or they're not mature businesses and then priced cheap.
Well, I think what we'll do is we'll wrap it up there, but I'll just do some little housekeeping for you. We will get a copy of this webinar put up onto the website, that particular website there, which is offer.intelligentinvestor.com.au/INES. And that's where you can actually apply, read more about this particular offer. You can also reach out to us, and you can send us an email at info@intelligentinvestor.com.au. Give us a phone call. If you've got questions, send them in, and we'll do our very best to answer. I know that Nathan's always happy to answer questions about the funds and the webinars as well. It does close on the 25th of October. So if you are interested in doing that, make sure you have that application submitted on that website before that date. And you've also sent the funds across. But apart from that, we'll get this up on the website soon. It's also going to be on the YouTube channel. And again, Nathan, thank you so much for joining us.
Thanks, Tom, and thanks everyone for listening.
Great. And we'll see you all next time.